Michalowski, Chief Currency Analyst for FXDD. And actually, I'm going to be also working with the people at Forex Live. So I'm going to be having two roles within the company, if you will, at FXDD and at Forex Live. So we're transitioning over to that website, our blogs, commentary. I'm very happy to be part of that as I am here at FX Street. What a great opportunity this company, FX Street, provides for you as retail traders to be able to listen to experts. And, I try to be as helpful as I can to you as a retail trader. And FX Street is certainly a portal that you want to be paying attention to. So I'm always thankful for what they do, how they do it, and the service that they provide to you. So let's give them all a hand in our own respective little houses or offices that we sit in right now. Before we get started, let me remind everybody that trading is risky, that traders should only use risk capital that they can afford to lose. I'm not going to be giving you any buy, sell, or hold recommendations, specific buy, sell, or hold recommendations here today. My purpose here and in all webinars I do is to just provide you traders with education. I've been in the business now for over 26 years. Not always doing foreign exchange, but one of the things that I have been doing, is what I have done in my career over the last 11 years has been with FXDD since day one. So I like to say that I've been able to see what traders do right and what they do wrong over that time period, and that's what I try to share with the customers, is that knowledge that I've gained from sitting at my desk for 9-10 hours a day watching markets, maybe 8 hours, sometimes 7. Well, a long time, 5 days a week, 48 weeks a year. You add it up, and I think it came up to around 21,000 hours. So anyway, that was a long disclaimer, but it gave you an opportunity to read the disclaimer here. I'm here for your purpose of educational purposes only. Now, today, what I'd like to talk about is trends. Trends are dear to me. Trends are where the most money is made in your trading. Is if you can catch a trend and stay on a trend, you have the potential for a nice increase in your account balance. I don't think anyone would disagree with that idea. We all know that trends are your friend. That's what we learn in Trading 101. But it doesn't necessarily mean that you are going to follow through on that idea that you want to trade the trends and stay on the trends. In fact, what I've found in my 11 years at FXDD watching retail traders is that it's really hard to stay on the trends. It's hard to do the step-by-steps through the trends, because trends, they tend to move fast, they tend to move directional, they tend to move in larger than normal trading ranges. We know that. I say that all the time. Fast, directional, and larger than expected trading ranges. But they do have, within those fast and directional movements, they have those dreaded corrections, those corrections that oftentimes get people scared out of the trend. Yes, you all can are familiar with that, and that's a problem in trading and the idea of these trends. We know that they are where the most money is made, where you can really have your account balance go up. But what we have trouble doing is staying on a trend. So stepping down or up in those trends, stepping through, I guess is the title of this webinar, stepping through the trends, taking the steps along the way, listening to what the market says, looking for clues in the market. And that's what I'm going to do here today. I'm going to focus on that. So although trends can vary, there are different types of trending markets. There tend to be some similarities in the trends, and I'm going to focus on those similarities today. Number one, trends often start from non-trends. This is most important to understand. It doesn't always start from non-trends. You can have a trend that goes down and then a trend that goes up, but a lot of times, folks, ladies and gentlemen, is that the markets will have a non-trending period that transitions into a trending period. Non-trending transitions to trending, and trending markets transition into a non-trending market. Just knowing that a non-trending market transitions into a trending market starts to put the odds of success in your favor, and also gets you geared toward thinking about trading a trend and staying on a trend. Because, folks, if you are anticipating a trend, if you think that the market is non-trending now and has a potential to trend either to the upside or the downside, I often keep a neutral bias when I see a non-trending market. Forex market can, and especially in the recent times that we are in, can go either way. You know, the euro can go up, it can go down. We've seen that over the near term, and so you have to be flexible on what you are thinking and doing as a trader in these types of markets. What you can do, however, is still anticipate a trend type move. That trend may not be for a month like the dollar yen has been in of late, but it can be still a profitable move. You know, those 100, those 200 pip moves. How many of you would like to have those? I think most of you would like to be able to step through those, even if they're little trends and they're clues that the market gives. But one of the things that you have to do in order to realize and step through a trend is that non-trending markets transition to a trending market, and that lays a foundation for you to stay on a trend. Knowing a market has a potential to trend allows you to stay on a trend. Second thing, trends are made up of lower lows and lower highs, or higher highs and higher lows. That's obvious. A trend will therefore step up or step down. If the market if you have lower lows and lower highs, then what is the market doing? It's stepping down. And then if you have higher highs and higher lows, then the market is an uptrend. It's stepping to the upside. So, just understanding that dynamic of a trend is important. They don't just go up in a straight line. They correct, and it's those corrections that really cause a lot of pain and hardship in a trend. So we're going to talk about how to manage that, how to see those steps as almost before they even come into existence or as they're developing. Third, upward or downward sloping trend lines can define a trend. I love to use trend lines. Trend lines are very visual. They're very, they're scenic. They're like the scenic overpass on the highways. You look at a chart and you could see the landscape below you or above you. Where is this going? A trend line that's upward sloping is giving you that scenic view of the trend. And oftentimes the foreign exchange market, in particular, because there's so many traders trading it, will respect these trend lines, won't they? They will develop a nice little trend line, and oftentimes there'll be multiple points along those trend lines, whether the trend is moving to the upside or the downside. So one of the clues that you as a trader should be aware of, especially when you're stepping through a trend, is where are these trend lines? Draw these lines in your charts, and it's okay to draw a steep trend and then have it flatten out, because what do trends do? They transition from trending markets to non-trending markets. Those are those corrections. So look for those times when the market is moving sharply to the upside and then sort of loses its momentum. That's a very important clue in the trend. You can use that idea, the break of the trend line, to your advantage, along with other tools that I will introduce during the analysis here today. But what I want to focus on at this point is upward or downward sloping lines can define a trend, and the more points you have on those upward sloping or downward sloping trend lines, the more important it is in you managing the trends and you stepping through the trends. I found as well that the channels are often formed that define the pace of the trend and the boundaries, or what I call guardrails, for the trend. Again, the foreign exchange market, lots of traders looking at the same thing. They're all looking, if they're on the trend, if someone's on each upward sloping trend, they are looking for levels where they can take profit, where they can define their risk against, let's say, an upper boundary or a top side channel trend line. It's hard to visualize right now without looking at the chart, but we'll be going through some charts here, and I'll show you exactly what I mean in regards to these channels and how they can be helped in your trading and stepping through a trend. The top channel trend line in an uptrend can signal a profit-taking opportunity, can it? Market's moving sharply to the upside. Has momentum in an upward sloping formation, and it gets to that top trend line. And oftentimes, guess what? Traders are very happy to take profit where they can define their risk. Where if the market says that there should be resistance at this level because it's a trend line, because it's in a channel, they'll take profit against that level. Why? Because they can always buy if the market accelerates through that top channel trend line, can't they? You can always get back into a trade if the market it starts to accelerate in that direction. And we don't know whether it is or not, but what we do know is that when the market hits that top trend line, there tends to be some sort of resistance against that level. That's why it's there. That's why traders, the fact that traders can define risk against those levels, that's why they do it. Now, of course, on the bottom channel trend line, in a downtrend, they can signal profit-taking opportunity on the downside as well. When a defined channel line is broken, so we're in a channel, the market's moving to the upside, and that situation where the market extends above the top channel trend line. You may sell against that level to take profit, and the market moves above that. What is that saying to you? That is saying that the trend is accelerating. That's what the line says. Move above a channel trend line, and it's accelerating the trend. There's more buyers. There's even more buyers entering the market at that point. And what I like to warn people is that trends are fast and directional, have larger trading ranges. So don't ignore the acceleration. Don't ignore these accelerations that go above a channel trend line. However, what you also have to be aware of is sometimes the market is searching for those stops, searching for those accelerations that occur when the market breaks above a channel. So that's just what you as a trader oftentimes worry about, is those stops being triggered by those big guys, those guys that come into the market and take you out or that push the market above this channel trend line. Well, if you're trading the trend, you're taking profit against that level, but if the market should move above that level, it's okay to go back long again at that level because the trend is accelerating at that point. Trends are fast, directional, have large trading range, so you don't certainly want to get out of the trend, but at the very least, what I want you to do is make sure that you don't trade against trend because that line is there. And so if you were to sell against that level and have an outright short position on an upward sloping channel that breaks that acceleration, don't waste any time getting out of that trade. Take your loss because the trend is accelerating. Don't ignore it. But if the market, and this is the big but, is that if the market accelerates outside of a channel and that channel fails, that could signal the end of of the trend. And a lot of times when that market fails in the acceleration above the channel trend line, it often gives you a better opportunity to kind of look for that correction to step through, to look for the correction that steps down and then steps up. I got a question coming in here. Can one big bank move any currency as they please? I definitely think that the big boys or the banks or the institutions, the big hedge funds, so on and so forth, are the ones that push the market from being neutral to buying or selling. They are the ones that, with all the zeros at the end of the counts, are able to push the market and take a balanced market, which is what is defined as a non-trending market. Market is balanced between buyers and sellers, and make it an imbalanced market where buyers overtake sellers, sellers overtake buyers, and that causes a trend. Typically what happens, however, is that it's a combination of buyers that cause the market to move in a trend-like direction. So it may start with one big bank that pushes the market through a key technical level, and then other traders come in, because guess what? They want to catch the trends. The big guys, the guys who make the most money, the guys who are able to trend the market, as you suggest, they are in this market as a career to make money, or otherwise they get fired and they lose their houses in Greenwich, Connecticut, and such. So they have an incentive to move this market, to trend the market, and they have a lot of zeros at the end of the count to allow it to happen. You as a retail trader, by the way, do not have that luxury. You cannot move the market. You can contribute to a market trend and as a group combine up to make that trend continue in the direction that you want, that the big guys are moving it, and that's what I urge you to do, is to be the follower, to listen to what they say, to listen to what the market says, and go from there. So I hope that answered your question. But it typically takes a little bit more than one. They can get it going, but it typically needs some more support. And I'll show you where you can define that support, where you can see where the market is finding support. Another thing about trends and stepping through a trend is this important thing, and this gets back to that question, and that is holding a 38.2% retracement is a good sign in a trend. If the market trends to the upside and comes down and holds a 38.2% retracement level, that says to me that there is good support in the market. The market will trends to the upside at an accelerated pace. It corrects and comes on sale by 38.2% retracement, or 38.2%. It's on sale at that point. And if there are buyers that come in against that 38.2% retracement, that means that those buyers who initially pushed the market to the upside at that accelerated rate are still there. I just have to make that assumption that they hold the 38.2. Those buyers are still supporting the market, and maybe some of those other banks that you brought up are starting to enter at that corrective level. They missed the first part. They're happy to enter at the 38.2 and keep this bullish bias going. Why do they enter there? Or why is that a retracement level important? Well, they can define risk against that level as well. If the market should break below that 38.2, I'll give it down to the 50%, but if you get a trend type move to the upside and a step down on a correction, if it goes much below the 50%, I'm getting a little bit wary of that trend. That's kind of the midpoint. That's the fulcrum of the seesaw. The market should buy 50% if it's going to continue to the trend to the upside. There should be buyers and other buyers out there who are against it. What else happens at the 38.2% retracement that helps contribute to the upside? We know that the buyers who push the market to the upside, if they're really intent, they're for real, they want this market to trend further, they will come and support at the 38.2% retracement at that sale price. But what about the sellers? What about those sellers who sold the absolute high of the leg to the upside? They can see that the trend is to the upside. They're trading the counter trend. And what they do as a trader of the counter trend is look for clues that the trend is ending. And one of those clues is a break below the 38.2. And if it can't get below that 38.2% retracement, or at the worst case, the 50% retracement, they get nervous too. So not only do you have the buyers who are there supporting the trend, you also can have the counter trend traders who may have even sold the absolute high of that leg to the upside. And again, I'm just speaking in terms of bullish right now. Sold that leg to the upside. They get nervous and they actually join in with the trend buyers. So you get the counter trend traders buying back their position. You get the new buyers or the trend buyers buying at the low, and they, guess what, overtake the sellers, and that's what causes the market to go up. If you look at there, what do you get? I'll get to that question a little bit later about the where do I put my stop. I don't want to in a trending market, 78% is too far of a correction. That's past the midpoint. I would almost put it at the 50% and watch what happens at that level. It may go a little bit below the 50%, but if it goes 78%, too far. Then it's probably on its way the other way. To be honest with you. All right, fine. I got a couple more. I like to measure the retracements in the legs of a trend. If the market is trending to the upside, again, I'll use that, the upside as our bias here. What that means is that buyers are overwhelming the sellers. And so the burden of proof in a trend type move that's fast and directional, in a trend leg, is on the sellers to prove that they can overtake that 38.2 or at worst the 58%. If those sellers can not push that market below that level, even of the last leg, trends are made of legs. You get one leg up, you get a correction. You get another leg up, you get a correction. You get another leg up. I will make it easy for the sellers to overcome a area. And if they can't push it below the 38.2 of just the last leg, then they don't have anything. They don't have a leg to stand on. So again, I will show you how that looks in a trend type move, and I think you'll be intrigued by the way that it goes. When the market trends, the 100-bar moving average on the 5-minute chart increases in importance. I use a 100-bar moving average in all my analysis. I use it on the 5-minute, on the hourly, on the daily chart. And when I'm looking, when the market starts to trend, obviously the 100-hour moving average is going to lag behind. But the 100-bar moving average on the 5-minute chart is a nice pace. It's a nice pace to measure, especially corrections in a trend type move. So when the market scoots to the upside and starts to consolidate as the market moves from a trending market to a non-trending market or consolidation market, that consolidation oftentimes allows that 100-bar moving average to catch up with the price as it delays behind it, as it lags behind it. And when that 100-bar moving average and the price start to converge, that's a point where the market has a decision to make. Is it time to continue the trend or end the trend? And so I will look at that 100-bar moving average as a clue as to whether this market is stepping up further to the upside, or is this trend over? And again, I will show you in our example. So let's start with our example. Let's finally get to the charts, and we'll see the evolution of a trend, how these tend to step to the upside or step to the downside. And folks, again, there are different nuances that you'll see in these markets, but the rules kind of remain the same. What you're looking for to confirm a trend remain the same. And oftentimes, even if you miss the early part of a trend, you'll be able to catch another part of a trend by just defining your risk against using these simple rules, simple things like trend lines and Fibonacci retracements and stuff like that, and moving averages. So what we've learned is that typically a trend starts with a non-trend, and so the first chart here, what are we looking at? We're looking at this non-trending market. The market has a higher low, and it's got higher highs and higher lows, and this is converging into a nice little triangle. Now everyone knows that this exists, but we also have in here our two moving averages. The blue line is a 100-bar moving average. The green line is a 200-bar moving average. So if you are looking at this chart and you know that non-trending markets transition into trending markets, you are going to start to really pay attention to what's happening here. And the key here is that we get a break. We can define our risk here on the break. How would you define your risk here on the break? Well, you could use either this 100-bar moving average as your stop, which is only a few pips away because this market is non-trending, or something like the 200-bar moving average. This is at 131, 34. This break point comes in at 43. We're only talking about 10 or 15 pips. Folks, if the market went up here and broke above this non-trending part and then started to move back down below the 200-bar moving average, I would get out. I would start to think about getting out. But what you as a trader do is try to put the odds of success in your favor by understanding that the market is non-trending and in a narrow range here, and you see a break and you start to go with it because non-trending markets transition into trending markets. We don't know what's going to happen in the future, admittedly. But what we do know is we can define our risk and we keep our risk to a limited amount here. And what we're doing is anticipating a trend. If the market does what we think it should do, and oftentimes in the market non-trends, it will do that because guess what? Those guys who move the market need to make money, and so they push the market to the upside. Then we kind of have what I call the trader's luck. It's a simple moving average, by the way. Trader's luck. Trader's luck. And trader's luck is when you define risk, you limit risk, and you have the market, those big boys, agree with what you say. It has nothing to do with you being able to push the market, because you cannot push the market. You need the luck of the other traders coming in with you. Those guys who are going to push the market to the upside. So don't ever think that it's your skill. You just have luck that you go along. But it is skill. It is skill to define your risk, limit your risk, see the setups, and either you're going to be right and you're going to catch a trend, or you're going to be wrong and you lose a little. That happens all the time to me. I lose a little all the time. It's not uncommon. It will happen. but what you're trying to do is catch a trend. If you catch a trend, it'll be okay. Anyway, so that's our chart number one. That's the setup. That's kind of the setup, and it's very plain to see. How do you trade the trends? Well, let's get into that question now. So now the market starts to break up, and you're long because you see everything is in front of you, and you're looking for the market to trend. Typically happens is the market, because it was non-trending here, people will be scared. People will be scared of the first leg, either to the upside or to the downside. So you'll get a nice little small trend move to the upside here, followed by, typically a consolidation. Now that consolidation will be in different forms. But what is important to note here is that when the market starts to trend, what does our moving average start to do? It starts to move higher, right? So same with the 200 bar moving average. We start to see this non-trending 100 bar moving average is going flat here, and this 200 bar moving average is going flat. That's, by the way, indication of a non-trend. Now we start to see it start to move to the upside. So we get this move to the upside, and we get a consolidation here. Time for the Fibonacci retracement. Time to put in that Fibonacci retracement from the most recent low to our highs here, and start to measure 38.2. Now I put it up to this high right here. If I put it up to this high, this would come in around 38.2. If I put it up to this high, this low would come in about 38.2, just a little bit below it. But you can see here how this trend to non-trend consolidated here, and the market, guess what, found some support against the 38.2% retracement. During this non-trending time, the market was able, the 100 bar moving average was able to catch up with the price as well. It's moving to the upside, and this is that point where I like to say that the market has a decision to make. Does it want to continue to trend higher, or does it want to break below? It's all right here, folks. It's all either going to win or lose by what happens against this 100 and what happens against this 38.2. If it breaks below this level, I wouldn't be surprised if we were looking at a chart that went this way instead of this way. The fact that it held that level gave the buyers confidence that they could take this market to the upside, and that's why traders start to enter the market at that point where they can define risk, limit risk, and hopefully the market agrees with them and it moves higher. So this is step one. This is it. This is what you should be looking for. Move to the upside, consolidation, correction to 38.2. If it holds at 38.2, bingo. That is great. That is a clue for you that this market has a potential to move higher. We don't know how high it's going to go. All we know is that we know our risk is defined, our risk is limited, and let's see if this market continues to trend to the upside. So that's step number one, and that's what I look for in any potential trending market, is for the market a move, a correction, holding a 38.2, maybe, and then a move back to the upside. I'm looking at a 5-minute chart here to analyze fives because that's, in a trending market, you really want to pay more attention to the 5-minute chart. It kind of leads the way to the upside. So what happens next? So we get this fast, quick, directional move to the upside. You who bought the market here because you missed the buying here are happy, just as happy as the guy who's still long at this point right here. You made a nice quick move to the upside. You traded the trend to the upside, and then the market finds a peak here and starts to come down. Put your Fibonacci retracement here. If you're long at this level, and you have two choices. One, try to pick a top, or two, try to see if the 38.2% retracement holds or down to the 50% retracement. See what this correction brings. If you can stay with the trend, great. If you take profit because it was quick and fast and you want to go play golf, that's great too. But if you can stay with the trend, especially if you're long from down here, give it a 38.2 of this leg. And notice here that I'm using the most recent leg. I'm not just coming down here. Those traders got long here. I'm not just measuring 38.2 up here. I'm saying, sellers, prove to me that you can sell it below the 38.2 of this last leg. Buyers overwhelmed the sellers here. It's pretty obvious there. You want to see if they can push it below the 38.2. If they can't, they're going to feel the pain. And guess what? Those buyers against the 38.2 who are going to risk the difference between 132.10 or 12 and 130. 32 even, or maybe even down to the 96 level. That's the risk that traders going to make for the potential for what goes up here. So what do we see? The price holds a 38.2% retracement in the last leg. Stay with the position. If you're long here, stay with it. Give yourself a stop here. Manage that trade so that you can have the potential to stay on the trend. If you lose because the market goes below the 132 level, okay, you had a gain from 131.42 to 132.02. Not bad. You made 60 pips on the trade. Be happy with that. Sometimes you have to invest in your business, and that's what traders do, who trade the trends. They invest profit in their business. They're not going to lose any money. They invest profit. You should try to do that too. So now let's put some channel trend lines in here. The market came down. We held the 38.2. Market came and had another nice leg to the upside, and put a trend line in here. Can also put in a parallel trend line up here. You can see how the market is working here. Market moves up to a high here. We break below the trend line, break below the 38.2, but we hold the 50% at this point. So as the market, a dynamic of the market is that trends will eventually transition into non-trends, right? Trends will eventually transition into non-trends. Clue number one, break through the trend line, break through the 38.2. It starts to show some signs of non-trending. Now, we do hold the 50%, and that gives the traders some confidence here. If you got out in this area right here, good for you. You made the extra legs to the upside. Maybe you're up to 100 pips or so in the move to the upside. Not a bad trade. Sorry, let's go back to that one. If you're able to recognize that the 50% holds and the market starts to move back above the 38.2 and you get back in this trade, maybe you catch this other leg to the upside here that takes the market to a new high. But notice here how this break to the new high is a little less than this break to the new high. It's a little less than this break to a new high. We're starting to lose some momentum, and you as a trader have to realize that non-trending markets transition to trending markets, and trending markets transition into non-trending markets as well. There's still some bullish tendencies above the 50%, moving back above a 38.2. All that is kind of lurking in your favor, but start to recognize and see the trees to the forest, see some slowing of the momentum. And when we go up and we make this new high right here, off of that 50% right here, that 50% point, make this new high, and just have a modest move above the old high right here. What do? We can start to put in these trend lines, these channels. And remember, our channel was a little bit steeper here. Now we're getting flatter here. Draw those lines in, folks. Put a parallel trend line on the top. Start to connect lines along the way, and you can see how that trend line that went this way, steep here, is getting flatter here. We also know that the market's moved 139 pips, and what's the significance of that? Well, it's 139 pips. This is less than that. So the market does get tired, especially in an intraday type trade, a trend type trade that we're seeing here. The average range, by the way, is about 120 pips, and that's important for you as a trader to know as well. So we are above the average by about 20 pips here. So I'm not surprised that the market finds some resistance up here, finds some resistance in this area against this channel here that we put in that connected this low here, put a parallel channel here, broke above the first channel trend line, held below this upper channel trend line, and failed. Remember I said sometimes in channels you get these failures, and these failures oftentimes will lead to a sharper type correction. And that's what we saw in this case. That's a clue that you should look for, a failure of a channel that's a channel break, a channel acceleration. Look for that. Also, other things to take into consideration here is the move to the upside. It wasn't as great and as strong as this move to the upside. This was the old high. We moved above it. We went this whole distance. This was an old high. We moved above it. We went this whole distance. This is a high. We moved above it. We only went this distance. We went right to our resistance level, and the market found some willing sellers up there. Why? 139 pips. It's time to take some profit. So a thing that, or a technique that I will then do is then move the Fibonacci back further. Move it back to not this leg to the upside, but move it back to this leg to the upside. This is where really this momentum started here. And start to measure the 38.2 off of that level. Start to anticipate that this has a potential to move down further. Not a bad idea to get out of a position at this point right here, out of your whole position. It's starting to show some signs slowing there. But maybe this trend can continue if it holds at 38.2, holds above the 100-bar moving average. And the other thing is, look how far away we are away from the 100-bar moving average. The price needed to catch up with that price, needed to test the market. Ended up testing it and moving higher. Well, as we know in the picture, all trends do come to an end. They come to an end usually with a reason. Usually it's defined by certain things like, trend lines 1, 2, 3. Notice how the trend is getting flatter here. This line is getting flatter, and look what happens to the 100-bar moving average. It starts to catch up with the price, and that price or that 100-bar moving average also happens to dissect with the trend line here that's coming off of our lows. So is it logical to think that this trend ends right here at 132.65? Yeah, of course it is. And on the top side here, we also have a clue here. We have 1, 2, and look, at point number 3, the market moved just above that level here and failed and started to come down. So just like this correction right here, we started to see the reasons to be more seller here. We've also gone even further to the upside. Now this range is well above what is a normal trading range. So all the indications are trend is over. Market breaks below here. Trending turns into less trending, turns into non-trending. That's what we're seeing here. That's the dynamics of a trend over. Now I want you to take a look at this 132.90 level at the top side, and I want to bring up this next chart, which is an hourly chart. And this is our high. This is where the market's going up to that 132.90 level, right at this level right here, okay? And what do we see here? We're looking at the 5-minute chart, watching the market move to the upside. And off the hourly chart, what do we have here? Other clues, clues of where we're going in the trend. And so you as a trader, yes, you can use the 5-minute chart within the trend, measure those corrections, use the shorter term nature of a 5-minute chart to kind of show you the path to the upside. But eventually, or at some point, maybe the hourly chart or the daily chart is going to come into play. And that comes into play. Here's our trend. This is the day. The market moved through the 100-bar moving average. And by the way, look at how the market held resistance against that 100-bar moving average on our first. This is our first leg to the upside. What are we holding against? The 100-bar moving average. When we broke through the 100-bar moving average, boom, trend to the upside, correct, turn to the upside, correct. Note here how the market initially finds our resistance on our first high right at this 200-bar moving average, and then the market starts to move down. So we know from the hourly chart as well that we're getting into a point where this is time for the market to start to lose its momentum. Ignore that phone. Move this momentum. And indeed it does. The market breaks above this level, moves to our 90 high that we saw on our previous chart right here. This is the exhaustion move right here. We know that at 65 the market starts to loses its really momentum on the 5-minute chart. But on the hourly chart, we actually get an earlier signal right here at the 132.74. Trend's over. Market failed above the 200-bar moving average. Started to move below the 200-bar moving average. And note here, uses a resistance, uses resistance, uses resistance, 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 resistance. Boom, and what happens? The market even moves further to the downside. So it's all there in front of you, folks. That's the evolution of a trend. That's what tends to happen in these trending markets. Now, just to take it the other way, we saw on the hourly chart. Where are we going? Here we go. We're going back to the hourly chart. And we know, well, again, in hindsight, we have the hindsight, but we're still using our same tools right here. And this chart, what do we see? We see a trend to the downside. So let's see how that trend developed and see if we can apply the same dynamics that we just learned in the trend to the upside. Does the market repeat itself or have similarities, in other words, in what you should look for in a trend? So let's go to our 5-minute chart. And By the way, I just copied and pasted these settings or these boxes from when we were looking at the market down there. We had a non-trending narrow range, 100 and 200 bar moving average converged with the price. We see the 100 and 200 bar moving average moving sideways. Does that look familiar? Does that sound familiar? Isn't that what I talked about when the market was at the lows and the market started to move to the upside? Yes, we saw the same dynamics in the chart. The chart had a triangle formation at the bottom, and we have this triangle formation at the top. We have 1, 2, 3 different points. We have 1, 2, 3 different points. It doesn't always come out this perfect, folks. You know, sometimes you get a little break to the downside here and a failure. It might break a little bit to the upside and failure. But what's important to note is this box here. This box is defining a non-trending market right here. And non-trending markets transition to what? Trending markets at some point or another. We don't know how far it's going to go. All we know is that we can follow the rules, follow the tools, follow the retracements, follow the trend lines, do all those things that are going to define whether the trend is remaining in place. If the answer is yes, it's still remaining in place, then step down along the way, see what happens, see if the market does what you think it should do. All right, so we have the same formation here, and there's nothing but reasons to sell when the market breaks. Your stop is right here. Your stop is right here, and it's the same risk that we took at the downside right there. We don't know it's going to go anywhere, and it could go up here, and it could move sharply to the upside, and you would have a small loss on your books. That's what trading is about, taking small losses and hopefully getting big gains. That's what you're trying to do as a trader. So here we have the same thing, all the reason to sell when the market breaks below this level and the market moves down. So now let's take a look at this break to the downside. So we have our break to the downside, and it's a small trend lower followed by consolidation and correction. Same thing. It's a simple moving average. Simple moving average. Why not EM? I'll get to that. I'll get to that later, okay? But I use a simple moving average. So here we have the break to the downside here, and I put my Fibonacci down to the low. And what am I measuring? I'm measuring the 38.2% retracement. If the market can stay below the 38.2% retracement level, then I'm happy. All right? I'm happy that the market stays below that level. I'll answer your question. Don't worry, all right? I'll answer that question. That's not important. I use a simple moving average. So the market moves down and it corrects to 38.2% retracement. We have a nice little floor right here. Is the market, do you have any reason to get out of the position? No, I would put my stop above the 50%, or if I'm lucky, if time goes by, I'm short from here, I put my stop above the 100 bar moving average here. If it goes above the 100 and it goes above the 38.2, its trend is probably over. That didn't trend. That's what you have to do, is try to look at the market, make logical adjustments to what the market is saying, what it is telling you. So here it holds a 38.2% retracement. We have a lower low, and you can even draw a trend line here. It's the same. It's really almost the same format that it is right here. Trending turns into non-trending, which turns into trending. So the market ended up going down. So that, it's good close. So then the market moves to the downside. And I have to be honest with you today, folks, that this is the unemployment day where the market broke to the downside, and this is 8:30 when the U.S. unemployment number came out. Now, if you're short from up here, you don't want to take the risk of the unemployment report. You just get out at this point right here. But if you are short from up here because you saw this setup right here, and the market comes down to this point right here, you can put your stop up here, You're not going to make as much if the market moves the other way, but you have a nice gain. Things are moving along as in a trending type fashion. Now, if you didn't have a position in the unemployment report, let's say you didn't have a position up here and you're waiting for the number to come out, because that's the prudent thing to do. Risk is less after the unemployment report, after all the details are known. And, what could you have done? Well, we know that the market is in a trending market. We've seen the correction to 38.2. We've seen the move down and the correction up to 38.2 with this leg right here as well. We see the market move sharply down on the unemployment report. And it's time to do the same thing. Put your Fibonacci in of the leg. Make the buyers of the market push the market above the 38.2. The burden of proof is on them, not you, not the seller. The sellers are in control. The buyers have to prove that they can push the market above key resistance levels and we're going to make it easy for them and say, give me a 38.2 above that or above the 50%, and I'll give you the benefit of the doubt that you are now overtaking the sellers. If you cannot do it, then you are not in control and the sellers are still in control. And so what happens? The market comes down and we have this sharp correction with those quick buyers off the unemployment report, and the market comes up to around the 77 level. This 87 level is the 38.2. Now, the 131.86 level is a key level on the hourly chart too, and this is where you start to, take things to the next level, to the second derivative, if you will. We're not just looking at the 5-minute chart. We also have to pay attention to what the hourly chart is. And so you as a trader, after the unemployment report is known, could sit there and be an aggressive seller with a stop above the 87 level or 86 level. Why? Because I'm going to go to the hourly chart, and I'm going to look at this point right here, this blue line in this chart right here. And remember, we started this trend at the 200-hour moving average. And where are we heading? Just like this. Do the same thing. We're heading to the 100-hour moving average. Where does that come? 131.86. So now, after the unemployment report is out, after you know what it is, after you see the move to the downside, you can define your risk against a nice little level that's called the 38.2% retracement or the 100-hour moving average. Risk of the event is gone. There's increased liquidity risk, but you can define your risk against that level and say, hey, I'll take a chance here. All right? If you're lucky, great. And if you have the trader's luck, the market's going to move your way. It's going to go in that direction. If you don't have trader's luck, you're going to lose a little. You can define your risk. You're going to limit your risk. Probably limit your risk to the 90, 95, above the 95 level. If the market breaks to the downside here, comes back above the 50% retracement, moves back above the 86 level, guess what? It's probably going to the upside at that point. That's the way I look at it. And if it doesn't, then then that's unusual. Okay. So that's what I'll try to do. So there we go. We have the clues from the hourly and the daily chart. And what happens? Market comes up to this level. We break down here. We hold 38.2% retracement. We've seen this story before. And then the market starts its, going from a trending to a obviously non-trending or slower trend to the downside. Did we see that at the top? Yeah. Could we draw some trend lines here and along the bottom? Yeah. 1, 2, 3. Did we see that on the top? Yeah, we saw the same thing on the top. Folks, sometimes the similarities in a trending market are there. All you have to do is look for the little clues that are out there, using trend lines, using Fibonacci retracements. Make the people who are trading against the trend try to prove to you that they have the ability to move the market in the other direction. And you as a trend trader, you as a trader who gets in at a decent level because there's some clues in the market that says non-trending market, and you get a break and you have the market move in the direction, and you start to use tools like Fibonacci retracements to measure 38.2. And when the market can't break above the 38.2 or worst case a 50% retracement, you're now confident in your position. You're going to stay on that trend, and then you get the next leg to the downside, and then sometimes the next leg to the downside. And eventually you're going to get to that point where the market says, had enough. We're starting to non-trend, and you can start to see that the trend is now losing its momentum. When the market starts to move above the 100-bar moving average, starts to find lower lows, yeah, it's still trending to the downside, and that we have a trend channel. But when we start to hold these levels and the market starts to find support against it, I'm not surprised the market starts to do this, starts to do this, starts to do this, and then starts to move a little bit up. So that's the evolution of a trend. That's how I look to trade the trends. It doesn't always come out exactly the same way, but if you use these same tools and if you understand what a trend is trying to do, it's trying to move in a direction, you'll start to see the trends through the forest, or the trees through the forest, they like to say, around the world. So what you want to do is try to see the trends through the forest. That's what you're trying to do with using these simple trading tools and techniques. Thank you very much for all your time. I'll take some questions here. The first question that I have is, please answer question of simple moving average or EMA. It's a simple moving average. And why not the EMA or the MEMA? Simple answer to that is I try to keep things as simple as possible. I also try to keep things congruent with as many traders as possible. And I've in the way I analyze the market, I am not just using a moving average as my only tool. Okay, so I am using things like I'm using trend lines, moving averages, and Fibonacci retracements. And so I don't really have usually a trend line like we've seen here at the lows and what we saw at the highs tends to kind of give you an early idea. So I'm not all that concerned about having a quick moving average on the chart. I want the moving average to be a little bit. Okay, we'll finish in 2 minutes. I want it to be a little bit more paced out. And I've just found, and I have to be totally honest with you, is that I just find that the moving average, the 100-bar simple moving average, is just at the right pace, and I get to use it on the 5-minute, the hourly, and the daily chart, and people pay attention to it. So that's about it. So you may disagree, but that's what I use. RSIs and oscillators, they don't define risk. I've seen diverging RSIs and stuff before in the past, and that you cannot tell me where you're wrong using an RSI. You can only tell me that the market is overbought or oversold or has a potential to correct. So that is what I term an ambiguous trading tool, and this might be my last thought here. An ambiguous trading tool because it doesn't define your risk. A trend line can do the same thing as an RSI without not defining my risk. A trend line, it's bullish above and bearish below. If the market went below this level, then I'd be bearish. If the market stays above this level, I'm bullish. This may show the same RSI diverging, and you would say, well, I could use that. But if the market went down here, it would still be diverging, or it could still be diverging. I'm out if the market breaks the trend line. You're not necessarily out if on a diverging RSI in this situation right here. You're still looking, and you may get scared out 100 pips below this level. So that's why I don't use it. That's it for today. Sorry I didn't get to all the questions. I hope I answered your questions properly and to your liking. And I wish I had more time, but I just don't. But did the best that I could. Thank you very much for coming in. Thanks to the people at FX Street for their support. Bye-bye now.